Welcome to Tony Byrne's View with news you can use. Tony has over 32 years of experience as a chartered financial planner and wealth manager. Tony's passion is to help you retire early and live the life of your dreams with no financial worries. Now to today's episode.
Why the gain to pain ratio is the best way to measure fund performance. When reading Jack Schwager's amazing book, Market Wizards, recently, I came across a measure of fund performance I'd never heard of before. It's called the gain to pain ratio, or GPR for short. The reason I'd never heard of it was because Jack Schwager invented it. It was born out of his frustration with inferior risk-return measures such as the Sharpe ratio, which downgrades a fund which has very high returns because it's deemed to be too volatile. This is what Jack Schwager had to say about it in his book. Most people tend to focus only on return. As I see it, as a performance measure, return is only meaningful relative to how much risk was required to get it. You could always get a higher return simply by using leverage. That doesn't mean it represents better performance. One statistic I particularly like is what I call the gain to pain ratio. I define the gain to pain ratio, GPR, as the sum of all monthly returns divided by the absolute value of the sum of all monthly losses. This performance measure indicates the ratio of cumulative net gain to the cumulative loss realised to achieve that gain. For example, a GPR of 1 would imply that on average an investor would experience an equal amount of monthly losses to the net amount gained. If the average return per year is 12%, that's arithmetic, not compounded, the average amount of monthly losses per year would also sum to 12%. The GPR penalises all losses in proportion to their size. Upside volatility, however, is beneficial because it only impacts the return portion of the ratio. In contrast, the Sharpe ratio, the most widely used return/risk measure, penalises upside volatility. As a rough guideline, for liquid strategies, any GPR above 1 is very good, and a GPR above 1.5 is excellent. Interestingly, our associated company, Minerva Money Management's own fund, the CCM Intelligent Wealth Fund, ranks very highly using the gain to pain ratio with a score of 5, calculated by dividing 10 months of gains by 2 months of losses. That is an exceptionally high score according to Jack Schwager's methodology. By contrast, the fund is ranked with a high risk score of 6 out of 7 by its ACD, Carvation Capital Management, using the FCA's risk rating methodology, which primarily measures risk by volatility. It really doesn't make any sense, at least any common sense. Of course, this makes little sense, especially when you observe the graph of the fund's performance over the last 12 months, which can be found on TrustNet. If you look at that graph, you can see that over the last 12 months, the fund's performance hasn't been exactly what you would call volatile. It's just risen a lot, by 59.1% at the time of making this podcast. So if you are interested in assessing funds using a more appropriate measure of fund risk ratings, I suggest you instead find out the fund's gain to pain ratio before making your investment decision. You know it makes sense.
Thank you for listening to today's episode. If you enjoyed it, don't forget to share it with your friends and family. For more information, head to www.wealthandtax.co.uk.